Welcome everyone to an episode of the Endeavour Exchange where we're talking about all the trends affecting your money. Talking about a lot of good things today, inflation, home prices, maybe even some supply chain will make its way in. But to kick things off, Grant, we are going to the home, and the first question I'm throwing your way. We've seen interest rates are coming down, and we've seen the values of homes really pushing up with a lot of people out there searching the market. Homes going for way over asking price. And so the question today that came in is, how much should you spend on your home?
Yeah, this is a really good question right now because you're right. We've seen housing prices go a little bit bananas in the last year and a half since the pandemic started. And unexpectedly, probably so. But if you were to think about early on, but really they have gone crazy. And I've got a number of clients who are looking at properties right now or trying to buy one. And I have one client in particular. I think he mentioned to me last week that he's visited 56 properties over the course of the last probably 6 months or so. And they've been outbid and stuff like that on virtually everyone they've made an offer on.
It's a story you're hearing
and
every day.
That's so common right now. And so, I think this is a really good question. And there's no really one right answer to it, but I'm going to give some guidance on it because we can guide, but there is no really one right answer to it because it really does depend on where you live, your individual situation, and so on. But, I think that there's first of all, this is the biggest thing in your budget. So I think that's something to keep in mind. And that's why this question is important. There are some rules of thumb, if you will, or some general rules out there. I would take those as somewhat of a guideline, not necessarily an absolute, because again, there's no one size fits all with most financial planning situations. And this would be certainly one of them. So, one I thought I'd share just because I think it's interesting is there's a 50-30-20 rule. So, 50%, this is related to your monthly budget. So 50% of your monthly budget allocated towards your living expenses. So included in that would be, necessities, housing, transport, food, healthcare, things like that, things that you need to live. So 50%. 30% would be towards your wants, okay? So entertainment, going out for dinner, Jets tickets, you name it, things like that. And then 20% towards savings. I'd argue if you're doing 20% towards savings, that's really good. And if you could live in that 50-30-20 rule, that'd be pretty reasonable.
As long as the cost of the home, everything associated with owning a home fits within that 50%.
Fits within the 50% of after-tax income. Now, if you can do all of that, that's a pretty good. That would be pretty good. But that really depends on where you live. Like you go to a place like Vancouver or Toronto. Really hard necessarily to fit that housing, especially when you're early on into that 50%. So everything, it's all relative to the individual situation. But, I think there's a few questions that you need to ask yourself as you're considering what's important to you in this. How much is it, again, how much of these is a bit subjective, but how long will you live in your home for? I found this actually, when I was thinking about this question, I found it kind of interesting because if you're only going to live in your house maybe 3 to 5 years or maybe even less, the cost of owning might be more than you think. Because you think about in the first few years of paying your mortgage, most of your payments are going towards interest. There's very little of your principal is being paid off on your mortgage. So if you're only going to be living there for a short period of time, it might actually be more cost effective to rent because you're also relying on the market to be stable when you're trying to sell it. If there's a market dip when you're selling it, and hey, we've actually seen that a little bit here in Winnipeg because, housing prices have gone up, but the condo market hasn't kept pace with that. And I know a lot of people who are trying to sell their condo right now, and they're underwater from just a few years ago. So now maybe they overpaid a few years ago, but hey, that's the reality of it. So it's something to consider. If you're going to live in it 7 to 10 years, then owning probably makes more sense. That's something to keep in mind. Is it your forever home? That's a different story altogether too, because if this is your forever home, you're going to live in the next 30, 40 years, 50 years or longer, then some of these questions are a little bit different.
Maybe that 50% can be a little higher because your income, the career trajectory that you're on is likely to look a lot different in 3 or 4 or 5 years.
Exactly, right? And maybe you're willing to pay a little bit more because, hey, this is the house you're amortizing that cost over the next 50, 60 years or 30 years even. It's like an extra $10,000, $25,000 today over the course of that time. Doesn't mean a whole lot, to be honest. And ultimately, how much are you comfortable spending? Think about the down payment that you got to make. I mean, there's a lot of people that really strive to get to the 20% down payment. I'm not so if you're more established, great. When you're starting out, first-time home buyers, I don't think it's critical you get to that 20%. Because when you amortize out the CMHC insurance over the course of the mortgage, again, it's not that expensive either, and there is an argument to be made about investing the difference, and you're better off. But you got to think about your down payment. What's really critical, of course, when you're starting out is what's your monthly cash flow going to look like? Because if you're going to be house poor, you can't continue on with your savings. You can't do any of the things that you like to do.
A lack of flexibility in there if something were to go wrong.
Yeah, exactly. So I'd really hate for somebody to get in over their head on a house, and you do not have to go up to what the bank is willing to lend to you. And I think that's a really critical component of this as well. The banks are often going to lend you more than probably you should take on, and often more than you need to take on. So just because the bank says you can borrow up to this doesn't mean you should or you have to, for sure.
I wanted to come back to that, the 50, 30, 20 that you were talking about, because one of the mistakes that I see, and this comes back to that having that flexibility and not necessarily taking that amount that the bank is fully willing to lend you. But a lot of times we hear people talk about their home as an investment. So, I'm kind of asking the question knowing how I would answer, but what if someone came to you and was like, well, I am doing 50 towards living and 20 towards my investing because my mortgage and my home here, this amount, that's covering my savings.
Yeah. So I don't personally buy into that. I mean, I think a home is a home. And again, especially in Winnipeg, because housing prices don't go up that dramatically here. 2% historically is the average increase in housing prices per year. We've gone through periods where I know it's much more than that. More recently, that's what it's been. But even with all this recent growth, if you look throughout history, it's still averages 2% per year. So I don't buy it, especially in Winnipeg. The argument typically comes more from places like Toronto when we're talking to people there, or in Vancouver, where you do see more dramatic increases in pricing. But that's no guarantee either. Things can definitely change. So in my opinion, I like to separate the two out. A home is a home, and your investments are your investments. Now, if you have rental properties or other real estate, commercial real estate, whatever it is, that's investment to me. But if it's
generating you an income.
Yeah, let's put it this way. If your home is not something that you could sell for a better investment opportunity next year, then it's not an investment to me. If you're not willing to make that decision, it's not an investment. In our portfolios, whether it's real estate or stocks or whatever, we're always willing to go to the best opportunity. If we think there's a better opportunity, we can sell this thing tomorrow. So anyway, I think that's I would treat them differently. And a home is just a home at the end of the day.
Yeah.
Not just a home; it is your home. But I think it's also worth stating that, and I know we got to move on, but it's also worth stating that you don't necessarily have to own. Owning is not necessarily the best choice for everybody. And I know there's a lot of FOMO out there because people have seen dramatic increases over the last year in housing prices. It's all relative. Anybody selling a property to buy another property right now has the same problem on the other end of it.
Yeah.
So I wouldn't have too much FOMO over it. But owning is not necessarily the best thing. And in fact, a lot of our clients we've recommended to go to renting, especially later on in their, I shouldn't say later on in their lives, but in their retirement years, because the cost of renting can be far less than owning at a certain point. So owning is not for everybody. You don't have to own. If you're going to own, there's a lot of questions to ask and how much you should pay. I just think you should make it comfortable and reasonable for you, But it's an interesting market right now, and I think people are being stretched above their comfort levels to make purchases. So I'm going to flip it over to you, Brant. This is one we talk about a lot, actually, because, hey, let's face it, the media creates a lot of buzz, and our industry is, around all that buzz, because the stuff that we do is related to what's going on in the world and the economy, and especially in times like this, there's a lot of that stuff, a lot of noise out there. But the question is, why should you stop listening to people who make market predictions? Because everybody's famous for it. We try to stay away from it. People ask us all the time anyway, but why?
The crystal ball.
Yeah, why should you stay away from that?
We love dusting off the crystal ball when a client comes with a question like this. No, I'm kidding. Well, because they're BS for the most part. And I'll just give you a couple statistics here. So every December, Business Week surveys Wall Street leading strategists asking where stocks are headed in the next year. And over the past decade, the consensus, so when we look at all these strategists, the kind of average prediction that they've made has been off by an average of 16 percentage points. So like that's a huge difference.
So massive,
yeah, massive difference.
Yeah.
David Dreaman, a famous investor, did some research on this, and this is a little dated, but when he did the research, he looked at the past 30 years at analyst predictions over the earnings of companies, because every quarter we have the analysts who are making their predictions of where their earnings are going to be at next quarter, and on average they're wrong by 41%, not percentage points in this case. Like, it's not the difference between 1 and 16%. 41% of the time they're just wrong. Like, on an average, there's a 41% difference in where things actually go.
Yeah.
So that's like the weatherman coming to you and saying or weather woman, whoever, talking about the weather and coming to you saying it's going to be 30 degrees today, and it's actually 17 degrees Celsius. So again, pretty big difference. I don't know about what you wear on a 30-degree day versus a 17-degree day.
Well, that's Winnipeg in the fall, because it's like, you get up, it's -5, and then by the midday it is 30 degrees, especially this year. But you're right though. Can you imagine if the weather person was that wrong
every day?
They'd be fired for sure. So the weather person, the weather forecast is more accurate than the market predictions, and way more accurate.
Way more accurate. And we joke about them being inaccurate, but maybe if it's rain and whatnot. But anyways, the kind of problem comes back to when we're seeing people make market predictions. Predictions fall prey to two main problems. The first is we assume that whatever has been happening is the only thing that could have happened. And we know, just through obviously a lot of the reading and the individuals we follow and the philosophy we take, when something happens in the markets or the economy, there's so many different variables at play. There's thousands of, likely hundreds of thousands, millions of different scenarios that could have played out if something were different. We have individuals and people who don't always act rationally. We have individuals who are sitting in positions of being in charge of a central bank or a treasury, where a decision has a massive impact on then the behavior of everything around it. And there's just so many. In reality, what has happened is not the only thing that could have happened. There could have been a number of different scenarios that played out. So that's problem one. And then second, we rely too heavily on the short-term past to forecast the long-term future. We have this recency bias. We're not necessarily looking at when these individuals are making, market predictions, and you really dig into kind of this analyst earnings report or whatever. When you look at how they're justifying it and the assumptions that they're using, they're not going back 100 years.
Yeah.
They are using a very short-term period of time to help them with these predictions. And when it comes to the markets and the economy, that is way too short, and it's just not really all that useful if you're trying to predict these type of events. And so, on top of this, you already kind of talked about this, but the information that we're fed via the media, it's often overly dramatic in what we read and see. And why? Well, because that's really what gets eyeballs. Just look at what we're learning here from Facebook and the information and the whistleblower, everything that has come out about how negative, more controversial news is actually what gets clicks and activity on a Facebook. Well, it's the same thing in the media. It's anything that is more fearful. So the market's going to crash in the next year by 30%.
Yeah.
These are the types of headlines that the media companies absolutely know get the most play.
Well, it's no secret. I mean, if you watch any major news network, business news network in particular, and if you look at the pundits, the so-called pundits that they have on, it's often, and we joke about this, but it's often the ones that come on and predict. They're famous for predicting 10 out of the last 2 recessions because they're always calling for a
Yeah.
recession. That's why they get on TV.
You look back, it's like 2012, 2013,
Yeah.
2014, 2015, and here we are in 2021. And this isn't us saying that it's not going to happen or being
Right.
some big, super bullish on the market. This is us saying that the information that you're often fed is just not necessarily useful when you're trying to make rational
Right.
and smart investment decisions. And at the end of the day, we get it. It's human nature to read those headlines and kind of be shocked and, I don't want my portfolio to fall 30%. Well, neither do we. But that's where
believe
it comes.
us, we don't either.
We don't either. That's where it comes back to proper planning, proper asset allocation. At the end of the day, the information that you're getting from the media, 9.9 out of 10 times is not information that you should necessarily be acting upon as it relates to your investment decisions. What should you be doing? Well, regularly invest. If you're scared of what a market crash might do, or if one's around the corner and markets are at all-time highs, regularly investing in dollar cost averaging. So for those who don't know what dollar cost averaging is, it's essentially just having a systematized way of how you put money into the market. So whether you do it on a monthly basis, maybe you do larger sums over a semi-annual basis. You have something set up where it's at this time, I'm going to put this much into it. And what it does, when things are a little frothy, you're going to buy less when valuations are a little higher. And then when you go through that period of markets pulling back and the values coming down, now you're buying, you stick to the plan and you buy into that and you buy these assets at better, much lower prices, which when you're buying at that time, you're going to have likely in the next 5-10 years, those are going to be the best returns that you've seen from your portfolio. Diversify. We're cautious on all, standing on the top of the mountain and preaching diversify, because you can over diversify, but it is important to own different types of assets because they all, and we'll get into this a little more when we talk about inflation today, but it's important to have different types of assets that operate differently and have less correlation to necessarily the stock and bond market. So things like real estate, precious metals, having different assets can allow you to just, again, dollar cost average and ignore what's going on with stocks, bonds, this asset, that asset, and just continually keep chugging along. And then the last one, which I hope if you're watching, you've already got the point of this, ignore the market noise. Ignore the quarterly earnings reports. You don't have to ignore them altogether if you're a person who enjoys investing and you're following a company and trying to keep tabs on what management is doing. But you shouldn't be making knee-jerk reactions off of that type of information. So we'll leave it at that unless you have anything else to add.
The only thing I'll add is that we often get sent a lot of articles from clients, and it's usually like an article that they might be concerned about based on something that they own in their portfolio or something like that. And just keep in mind, you can always find 100 articles to support both sides of it, and you ultimately have to make up your own opinions on those things. But yeah, there's always somebody saying the world's going to end, and maybe someday they'll be right. But if you say it every day, eventually you'll be right. So in the meantime, you've missed out on the best market growth opportunities in history.
Exactly. If you were one of those who was listening to the people calling the market top in 2012 and 2013, you've been sitting in cash this whole time. That's probably the biggest mistake you've made with your portfolio ever.
And you never get that time back. So that's the key there. So.
Exactly. This one's for you, Grant. We touch upon this a lot in our planning with clients, insurance, life insurance. Today is really about term and permanent insurance, because there's more than just two types of insurance. But generally speaking, when we're dealing with life insurance, there's term insurance and there's permanent insurance. For listeners who maybe are going through this and looking at different insurance policies with an advisor out there, what are the key differences between term and permanent insurance?
Yeah, this comes down to the purpose behind the insurance more than anything else. As the name puts it, like a term insurance policy is a term, a period of time. A permanent insurance policy, naturally, is a permanent policy that's in place until the day you pass away, basically, as long as you pay the premiums. So the purpose behind them is really important, because depending on what the reason is, if it's a shorter term need, then a term insurance policy is probably more appropriate as long as it covers the need. The big difference between the two is ultimately cost. Term insurance policies, truthfully, they're designed, and I say this a bit tongue in cheek. Yeah, they're designed to never pay out. Mm-hmm. Not that they wouldn't if something happened to you. I mean, they're legitimate policies, but they're designed not to be paid out, because if the insurance company ever thought you were going to pass away during the term, like let's say you get a term 10 or a term 20, mm-hmm. 20-year, 10-year policy, they wouldn't give it to you if they thought they were going to pay it out. So the good...
Or they charge you a whole whack of money.
But in that case, you might as well just self-insure it, right? Because they're not stupid. They know that they're going to have to pay it out then. So anyway, if they're giving you term insurance, it's designed not to pay out, but it's there to cover the catastrophic, the thing that would happen in the event that an unexpected death, in this case, happens with life insurance. So, and we often use these to cover shorter term needs like mortgages. Like a mortgage, although it could be 20 or 30 years or whatever, that's a shorter term need in the course of your life. And so we would often use a term insurance policy to cover that particular need, or even protecting just from income, income replacement, because most people are planning to retire at some point, and so the income replacement need is not a permanent need. So a term insurance policy is really good for covering those types of things because it's really cost effective. It's often way less expensive, way less costly than a permanent insurance policy. On the other side of it, a permanent insurance policy is guaranteed to pay out.
Because you will die at some point.
Because you will pass away at some point. And so that's the difference from the life insurance company's perspective is, well, we're going to pay this out, so we have to charge more because it's a guaranteed that it will pay out as long as you are paying your premiums. Mm-hmm. So though a permanent policy would be covering more of those longer term needs, like estate planning needs are quite common, right? Because if you're predicted to have, when we do your planning work, for example, and we're predicting that you're going to have a tax liability of hundreds of thousands of dollars, maybe even millions of dollars in certain clients' cases, a permanent insurance policy is a really good way of paying for that tax liability. Mm-hmm. We joke about this a little bit, but it's like you get to choose who inherits your money, and if you don't want CRA to be the one that inherits a good chunk of your money, well, then a life insurance policy is a really cost-effective way of taking care of that. You often pay pennies on the dollar for what the ultimate tax liability is. So for something like that, permanent policies have added bonuses of having cash values often in them as well.
Investment portion.
It's an investment component, and so we deal with it a lot, especially with our corporate, like our clients with corporations, because it's a way for us to shelter money in a policy from taxation, from the growth on the investment, because it just falls under different laws as it relates to the Tax Act. So insurance policies, a lot of people still don't know this, but any cash investments that are growing within the insurance policy grow tax deferred, kind of like an RSP, but they're tax deferred, so you're not paying income tax growth on it every year. And if you have a corporation you're investing, you might know that you're paying the highest tax rate on that growth every single year. But in an insurance policy, it's deferred till down the road. Also, there's a lot of benefits that adding to your capital dividend account, like insurance policies will add to the capital dividend account, allowing you to get money out of your corporation on a tax-free basis. Things like that. So there's a lot of tax planning that can be done, really great work, especially with people with corporations. If you haven't had that looked at, I would strongly recommend it. We'd be happy to look at it, of course, because there is a lot of really great tax planning work that can be done in that respect. But I think just the gist of it, the life insurance component, just more permanent needs. So you are going to pay for that. It's going to be a little bit more money on a monthly basis or on an annual basis. But the reason is there is a guaranteed payout. And so it could almost be looked at more of as an investment, because there is that windfall of cash that comes at the end of it. Now, you just have to go through the unfortunate event of dying to get the money, but for your family, that could be all the difference. And again, there are some benefits while you're alive as well, with tax deferred growth and et cetera, et cetera.
Yeah, it's important. The only thing I'd add is if you're going through one of these decisions, it's important to seek out really competent and qualified advice, because we just see a lot of people going into insurance policies that they don't necessarily understand what it's for, why it's used, and end up in situations where they just didn't understand the
We've
product.
seen all spectrums of it. I mean, I've seen a lot of young professionals get talked into some really expensive policies that were probably not necessary at the time, and especially with when they're starting out in their careers, their cash flow is a little lower. That's I think a little questionable. And on the flip side of it, we've seen people trying to use term insurance to cover permanent needs.
Yeah.
And the reality is they just won't work.
Yeah.
So you're paying to something that will never get you what you want. So it's worthwhile talking to experts on that. Okay, so Brett, I'm going to throw this one back to you. So inflation. Inflation is a huge topic right now.
Major.
You and I talk about it almost daily.
We've been talking about it for a while, though.
Yeah.
So
we've been talking about it for a while, but like really, we're actually seeing it now because we weren't seeing it so much. Like we've been talking about it since 08, 09. Like really, that's like when the government started printing all this money.
Yeah.
We thought inflation was going to come in a big way then. It hasn't, but now it is. And we're seeing like 4% per year inflation, 3% plus certainly in a lot of cases in a lot of countries around the world. And so anyway, there's a couple of questions here really, but like first and foremost, how do you protect your investment portfolio from inflation? Because we were just talking before we went out live here, if inflation's running at 4 when you're expecting 2, your portfolio has to make up that big of like at least a 2% incremental difference on what you were expecting before,
I think it's helpful first to let's kind of talk about what inflation actually is and why it's bad, because I don't necessarily feel like a lot of people fully understand this. Inflation is a sustained upper movement in the overall level of goods and services in the economy. So essentially, things are just getting a lot more expensive when there's inflation. It's effectively devaluing currencies or your money. So when a unit of currency depreciates, so if I have $1 and it depreciates, that dollar is then going to buy me less.
Right.
So you could think of things like groceries, medical bills, rent, all these things. The
housing,
dollars, housing,
gasoline.
The dollars I have aren't going to go as far because the higher the inflation, the quicker that they're being devalued at.
Right.
And it's especially a problem when inflation is running higher than wage growth. So things are getting more expensive than people are seeing their wages grow. Because then that's now we're really going to have some problems in the economy. And as you mentioned, Grant, there's been a lot of talk about this inflationary environment, and the reason being, well, here in Canada, we just recently saw it accelerate to 4.1% in August, with 7 of the 8 major components that they use to measure it rising. The biggest that we saw was transportation and gasoline contributing to this number. I'm sure you're seeing it. Everyone's talking about it. You go to the pump, you're like, holy smokes.
Yeah.
Look at the price of gas.
Yeah.
In the U.S., we saw it edge up to a 13-year high of 5.4%. The main upward pressure was coming from the cost of shelter. We saw food, homes, vehicles, and again, energy, so gasoline, oil, things like that. So, as you mentioned, we're seeing inflation a lot higher than what has traditionally been expected. And for those who don't know, central banks typically, everyone's a little different, but central banks across the world typically target anywhere from 1 to 3% inflation. Generally, the target is that in between, right at that 2.
Right.
Because there's some positives to having very mild and moderate inflation. Most economists would agree on that.
Yeah.
Right now, we're seeing it accelerate at a much faster pace, higher, unexpected, and to this point, we've been seeing it for a little bit longer than it's being talked about just today. But to this point, it's been argued that it's transitory, that it's temporary, and that COVID and the whole stopping of the economies and then turning things back on, that that's just caused this very short-term burst of inflation, and even when we look at, if you measure it back when everything was shut down and you look a year out because it's an annualized number, that's kind of skewing it. But now there's some concerns out there that inflation is actually going to run a little hotter, and that all this cash that's been pumped into economies across the world, that there's actually a much deeper problem here, and that it's going to last longer. At the end of the day, whether you believe inflation is going to be transitory or not, to me, shouldn't really matter all that much, because I'm of the opinion that if you're wrong and inflation is here to stay, it's not something you want to be caught off guard by. So if there's risk out there, I would way rather plan for that worst case scenario. And so, to your question, Grant, what do you do when you're planning with your investment portfolio. And we have a couple kind of key items that we believe you should do with the portfolio to help protect this. The first being, you got to start looking at alternative assets. So when we say alternatives, things like market neutral funds, which have much less correlation to the stock and bond market, and have even the ability to be positive. And we saw this through COVID, positive during a negative market. So down markets where we're seeing stocks and bonds fall in price. Our market neutral funds that we held for clients were actually positive during that time, helping weather that blow that COVID initially presented us. Own a business that's demonstrated strength and pricing power as shown by their growth metrics and their ecosystem control. This comes from our portfolio manager here that runs a lot of our models, Craig White. You want a business who has the ability, if their inputs and the costs of running that business are increasing, you want a business who can actually pass that and has pricing power to pass that along and be able to raise prices. Otherwise, you're not going to keep up with inflation. If they're not able to grow and reallocate that capital and earn higher rates of return than they're seeing than we're seeing with inflation, well, that business is actually slowly dying.
Yeah, and because we often get questions, it's like, well, are stocks better than other things in inflationary times? Not necessarily, but some are. Some are. So understanding the things that you own, the companies you're investing in is important.
And it's funny, we always approach our stock investments with that in mind, whether there's an inflationary environment. We like businesses that can raise their prices, that have pricing power, that have moats that allow them to. Those are the businesses we like owning because their product obviously is a good product if people will keep buying it as prices rise. You can even think of like an Apple, like the iPhones can get
even pretty big inflation on iPhones in the last 10 years.
And even then, it's our phone is such a valuable tool to us today.
Yeah.
I think there's a lot of people that's not the first thing that's going when the budget's tight.
Oh, no.
I know it's not for me. So, and then the third and kind of final key component to how we view inflation and how we protect our clients from it is diversity. And we talked about that a little bit with the alternative assets, but again, owning different types of asset classes, precious metals, things like gold. You might even be able to argue Bitcoin today. Having a diverse range of assets is important because the inflationary environment is just a very tough environment, and so you don't want to have everything in one thing and then get caught off guard and realize, holy smokes, I'm down 30% in these stocks or these bonds, because inflation is just a challenging environment to invest in. So
yeah, I'm just on that component, like that side of it. Like I think that is it believed that it's going to be a transitory thing, that's going to be short term? Like there's some waffling on that. I think when the central banks are talking about it, there's some red flags that I think they're seeing on their end, which might lead them to believe that maybe it's not as short-term as they thought. And I kind of believe that that's the case. I think that inflation, we're not looking at such a short-term thing. And so, we are going to be looking at it for a little bit longer period. I mean, and there's a number of reasons for that. I mean, like supply chain you mentioned earlier. Like supply chain is severely constrained. The global supply chain is severely constrained right now. And I was doing an interview last week where I was looking at different stages of the supply chain. And virtually every one of them is constrained right now, whether it's like shipping containers. There's not enough shipping containers in the world. There's not enough ships to send the shipping containers. There's not enough people working to produce and then ship the stuff. There's not, and you name it, like right across the board, there's so much constraint. So yeah, that's inflationary. Getting people back to work. How are we attracting more people to work? Well, we're going to pay them more. That's inflationary.
Because we've been seeing, that's been another major topic is the labor shortages, right? Well, if people aren't working, typically you have to offer them more to come work.
Right. Low interest rates. Well, we can't really, we have a tough time increasing interest rates right now because there's a lot of personal debt out there. There's a lot of debt in general. So increasing rates is hard. So low interest rates just adds more money into the economy as well, inflationary. So anyway, for all that, again, we talked about predictions, but it leads me to believe that you should be protecting yourself from inflation, because it's starting to look like it's going to be around for longer than what was originally expected.
Again, it's not. I don't necessarily view it from our perspective as a prediction. It's a, hey, we're assessing what risks are out there, and this is one of those risks that we really want to protect our clients from.
Exactly.
I'd rather give up a little growth to ensure that a portfolio doesn't get absolutely crushed in a higher inflation environment. The one thing I wanted to add before we kind of close things off today is I don't necessarily find again, back to here's our over-sensationalized headlines. This morning I read Jack Dorsey, CEO or founder of Twitter, calling for a hyperinflationary environment.
Yeah.
Again, a little, I don't, not here to make a prediction. I don't necessarily believe, and I know economists around the world don't believe that either, that we're on this brink of this hyperinflationary environment here in the West. So
I don't think so. But if you think about like 3% inflation or 4% or 5%, like that's
high.
That's high, not hyperinflation, but it's high.
Yeah.
And that's causing problems already. So yeah, I mean, we don't need hyperinflation to have problems to protect portfolios from. And yeah, I don't think we're heading into that either. But hey, when Jack Dorsey talks about eccentric things, he's going to get headlines.
Going to get some headlines, yeah. Going to get some attention.
All right. Well, I think that's good. Why don't we close it off on that note? So be sure to, with any questions, please feel free to reach out to us, especially related to these topics, because I think these are quite topical right now. So feel free to reach out to us anytime. Visit our website, www.endeavourwealth.ca. We're on all the social media. So it's Facebook, Instagram, Twitter, YouTube. Find us, and we'll be happy to chat with you there. But feel free to reach out to us anytime, and we're happy to chat anytime. Thanks so much.